I think you just got to take the long view, right? I mean, if you have a less than 4-year time horizon, you're just a trader. You're just a speculator. And if you think you're going to hold Bitcoin for 4 to 10 years, you don't understand Bitcoin yet. You should probably go study it hard, right? Because I think once you understand Bitcoin, you got to have a 10-year plus time horizon. And when you really understand it, you realize you should have a 100-year time horizon. I could say, Dan, first of all, on the cycle, I feel like there were 3 cycles since August 2020, right? I mean, Bitcoin ran up to about, 60,000. It ran down to the 30s. It ran up to the 60s again. It ran down to the 30s again. It ran up to 47, and we thought it was headed north. And then I think the Fed started cranking on the tightening, and then it crashed down. Right. And then we thought we were going back up again. And then the FTX thing happened and we got hammered again. So you could think 1 to easily 3 cycles in 24 months.
Michael Saylor, in his latest interview, finally breaks his silence on what he would say to investors that followed him into the Bitcoin trade, buying Bitcoin at $50,000 or $60,000, who are now down over 70% with Bitcoin trading under $20,000. In his latest interview, he speaks on his investment advice and how he sees the cycle playing out over the next few years. This comes off the back of Saylor making another purchase of another 2,500 Bitcoin, taking MicroStrategy's purchases to over $4 billion and total Bitcoin holdings to over 132,000. This shows that despite all the blowups we have seen in 2022, Saylor still has as much conviction in Bitcoin as ever. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
I mean, that's a humbling experience. I probably underestimated to a certain degree the volatility that we were going to have. In any event, I don't think it matters at the end of the day, right? You've got volatility as a digital monetary asset is coming to life, and as we monetize Bitcoin. So two thoughts. One, I never really took a 100-year time horizon. I never considered investing in anything for 100 years before I discovered Bitcoin. Mm-hmm. If you had asked me, in the year 2020, in March of 2020, is there anything that you would invest in for 100 years? Is it even relevant to ask about the outlook for the asset in multiple decades? I would have said, you're crazy, right? You don't know what Google's going to do in 100 years. You don't know what Apple will be. I mean, you don't know, you can't own that land for 100 years. You don't know anything really. You don't know that people will use natural gas. Oil may be obsolete. Maybe we'll use nuclear fusion. So why would you ever express an opinion about anything looking out 100 years if you couldn't imagine it lasting that long? And, the useful life of a company, the average life of a company or life expectancy of a company is like 20, 25 years. If it's a successful one, if it's a small company, the expected life is 5 years. The expected life of a house or a building, right, is not 100 years. There's no building that 100 years after it was built is still usable without substantial maintenance. So I think Bitcoin drew me into thinking hard about the theory of property. What is the half-life of something? Well, if you want to understand it, you have to understand the maintenance cost. So if the maintenance cost of owning a residential property in Florida is 2% taxes and another 2% a year in utilities and upkeep and insurance, then that's 4% a year. So that means in essence the half-life is 4 divided into 70. So I think Bitcoin really drives you to think about the theory of property, and it drives you to think about the theory of money. And when you finish, you realize that all the money you ever had was defective, and all the property you ever had has a shorter half-life. Once you factor in all of the natural maintenance costs and the risk factors, and this is where most people don't do this very well. For example, how do you calculate whether you have positive or negative yield on a loan to Celsius that pays you 6%, right? If I give my Bitcoin to Celsius or BlockFi and they pay me 6%, well, that's like I'm getting paid 6% rent, but then what's the real cost of the investment? And the cost of the investment is they might just take the money and never get back to you. So how do you assess that? Well, if you think that once in 50 years they'll fail, then that's 2% a year is the cost of capital. Then you have to put the risk-free cost of capital on top of it. So if I had $1 million in the current environment, I could go and get 4.5% interest from the US government on a 1-year bond. So the risk-free cost of capital is 450 basis points. Then if you think it's going to fail once in 50 years, it's 200 basis points more. So now it's 650 basis points. But now you actually got to consider the tax. So the tax, the after-tax benefit you have from making the loan, maybe you get paid 6.5% interest and your tax rate is 33%. So you're basically getting like 400 basis points after tax. I guess the point is, if you think that the firm might fail in 30 years, right, then the counterparty risk is equal to the after-tax return. And the real problem, of course, is you could have got, 300 basis points after-tax yield risk-free if you just put it with the federal government. So what does that mean ultimately? It means that you're basically taking on twice as much cost as you're getting yield if that firm fails every 30 years, which means that, another way to get, isn't it kind of ironic that you get to a conclusion, the half-life of your money invested in the Celsius Bank is 30 years if it fails once every 30 years, right? But of course we know that the risk is much greater, right? The risk is not they're going to fail every 30 years. How about every 10 years? Not even that. They didn't even last 5 years. So, but if you thought they were going to fail every 10 years, then you would have had to put 10% on top of that. And what you would have realized is that you're taking on, in essence, people are taking on a 30% counterparty risk per year in order to get paid 6%, or in order to get paid 4% after tax. They took a 30% risk, which meant that they were basically buying a negative yielding, minus 26% yielding. Although I don't know if many people even lasted 3 years, right? If the real risk was they would blow up within one cycle, which is 36 months, then you had a counterparty risk of 33% against an after-tax yield of, I think the reason to study Bitcoin is because if you study Bitcoin deeply enough, you would be able to articulate all the defects of money, like the fact that there's a 34% negative real yield or 30% negative real yield on owning the peso. If you understand that, if you understand there's a 30% negative real yield owning the peso, then you understand currency and money. If you understood that there was a 30% negative real yield putting money in BlockFi or an FTX or a Voyager or Celsius, then you understand banking. If you understand the risk of investing in Snapchat or Facebook or Alibaba or the like, owning an equity,